The Journal of Foreign Policy has named him one of the top 100 global thinkers several times. Way back, he received a BA and a master's from Oxford University, and as you would expect, he holds numerous honorary degrees. So please join me in welcoming Martin Wolf.
It's always so enjoyable hearing these sorts of introductions. It's a great pleasure to be here again, and I am really impressed by the turnout. I have to say I'm even more impressed by the art that surrounds us and by this room. If I'd realized that I was going to be speaking in a picture gallery of this quality, I might have felt even more daunted than I do. What I'm going to do in my remarks is to set out in a very, very big picture where I think we came from and where we are. I'm going to discuss also a little bit about where we might be going, but as I like to say, forecasting the future is above my pay grade. If I could do that, I wouldn't write columns for a newspaper. Of course, I think that nobody can forecast the future, but that doesn't stop people from trying. What I'm going to do anyway is to set out an analysis of, I think, where we are and where we're going. The title of this speech is The Shift and the Shocks. It'll become pretty obvious what I'm talking about. It may be already quite obvious. I should say that this is the title of a book I've just contracted to write over the rest of this year. And I stole the title from two very good friends of mine with their permission. They used it in a very nice little article, buried in the middle. Like most academics, they had no idea when they'd actually got a good phrase. So as I said to them, I'm going to liberate it. So the shift and the shocks, and how do they relate to where we are and going? The shift is, I think, pretty obvious. We are living through an astonishingly swift, unprecedentedly swift shift in the relative economic size of nations. And since in the modern world, economic power is the basis of power, it's also inevitably a shift in global power. I'd like to just start by laying out a couple of facts which sort of set out very simple way, very starkly, what's been going on. They won't surprise you perhaps, but I think if I bring them together, they will have a certain force. The first comes from the International Monetary Fund's World Economic Outlook database, universally used. And if you look at this database and you ask yourself, how fast have the current developed countries been growing relative to the current emerging and developing countries, you will find that up to the end of the 1990s, that is to say up to the end of the last century, the growth of these economies was roughly similar. In the 1990s, a small gap emerged, but it was not very significant, and the relative size of the developed and the developing countries in aggregate was roughly unchanged. In the last 10 years, the growth of the developed countries in aggregate has been about 1.75%, which is lower than at any time since the war. Over the same 10 years, the growth of the emerging countries has been slightly over 6%. And on the IMF's forecasts, this difference will widen further to something like 3.5 to 1. Just to put this in context, if that were to continue, the developing and emerging countries in aggregate, their economies will double in size, and that is the economy of 85% of humanity, roughly speaking, every 12 years. Well, we basically are growing hardly at all. And that leads me to my second figure, which is about what's happened during the crisis. Again, this may be completely obvious to you, but it is still very striking. If you take 2007 as the starting point, and you take the IMF's forecast for 2012 as the end. So this is just 5 years. Over that period, the economies of the entire developed world, that is the US, North America, that is essentially US, Canada, Europe, Japan, that's basically what it is, will have grown essentially zero. 5 years, zero. Over the same period, the economies of emerging Asia, which is East and South Asia and contains just about half of the world's population, will have expanded by just over 50%. This is an extraordinary and unprecedented shift that is occurring in the relative size of economies. In its nature, the only comparable event in the last 150 years was the rise of the US in the late 19th and early 20th centuries. But that occurred at a vastly slower rate, at a vastly slower relative rate. China is basically doing in 10 to 20 years what the US did in 40 or 50. Now, I've not just mentioned this in order to impress us with the speed and scale of what's happening, but I believe that it is still, that the significance of this change for what is happening to our economies and what has happened to our economies has been consistently underestimated. Indeed, that was one of the main themes of my Fixing Global Finance, in which I argued that in very significant measure, we in the West have been at the mercy of events that have been decided elsewhere. And I would like to just stress 4 aspects of what this shift has meant in terms of shocks, which is my second big theme. First of all, pretty obviously, the entry of the emerging countries in the world amounted to a huge labor supply shock, which changed the relative prices of different classes of labor across the entire world. And if you take the perspective that Raghuram Rajan, a very distinguished economist, of course, teaching here in Chicago, in his book Fault Lines, you would follow him in arguing that one of the reasons for the acceptability of, indeed the willingness to push on the extraordinary credit boom in a number of developed countries, was that it was one way to sustain the consumption of people whose earnings were not rising at all. And one of the reasons their earnings were not rising at all is that the jobs that they'd enjoyed as a sort of quasi-monopoly position when the West had all the industry were disappearing, and their wages and earnings with them. The second big effect was a long period in which the China price, you will remember that term, set the world price for labor-intensive manufacturers. And since China was pricing in dollars, that meant a fall in the price of a large number of dollar-based manufacturers over and above what the IT sector was doing in information technology related products. That led, and again actually Ken Rogoff of Harvard pointed this out, I think in a very important Jackson Hole paper some time ago, that led to a period when inflation seemed to be extraordinarily low. And I think that triggered a series of quite substantial mistakes by central banks in the 1990s and early 2000s, when in overwhelming probability they should have allowed the price level actually to fall. The third effect is that inflationary process was, of course, reversed from about 2004 onwards, when the impact of the emerging world on commodities started being strongly positive, in fact, overwhelming. The sources of demand for commodities for the first time, ceased to be the developed world and became important parts of the developing world, above all, of course, China. And that problem with managing imported inflation has bedeviled central bankers throughout the last 8 years and continues to do so today. And finally, and most importantly in my view, an extraordinary savings shock, or as Ben Bernanke has called it, the savings glut, namely a period in which the price of savings worldwide fell. This was an extraordinarily surprising development. and it followed very precisely the Asian financial crisis. And I have a very simple indicator, which I now use to show this. What you want to know to measure this is what's happened to the real interest rate on safe assets. And it just so happens that the real interest rate on safe assets has become relatively easy to measure in the last 25 years because there are substantial governments that issue index-linked bonds. The US has a relatively short history in this, but the UK has a very long one, and you'll be happy to know that when they both issue similar bonds, the prices of these assets move extremely closely together. So I use the UK gilt market, and you will find that in 1997, the real interest rate on the UK gilt market fell from 3.8% to 2% and never went above it. A fall in the real interest rate from 3.8 to 2% is really big stuff. And of course, in my view, I don't have time to explain this, in my view, that triggered the asset price bubbles that we saw in every credit elastic Western economy, above all in the housing market. It was the trigger moment when these booms started. I wrote a recent piece in which I pointed out how closely coincident this fall in interest rates was with the beginning of the rise in house prices across a wide range of developed countries. But I would like to emphasize another aspect of what happened at that time, starting with the Asian financial crisis and directly linked to this notion of a savings glut. And that was an extraordinary rise in the current account surpluses, which is, of course, the capital exports of emerging countries, and above all, China and East Asia and the OPEC countries when the oil prices started to rise. These surpluses increased roughly 6 times relative to world GDP between 1997 and 2006. And it so happens, and it is a really extraordinarily neat story, it is almost unbelievably neat, so it makes one feel suspicious about it. These entire surpluses were absorbed, along with the surpluses of the old industrial surplus countries, basically Germany and Japan, were absorbed entirely by 2 groups of countries. The first group was the US, which absorbed 70% of them, and the other group was peripheral Europe. Peripheral Europe was West Europe, Ireland and the UK, Southern Europe, you know who they are, and Central and Eastern Europe. And the countries that absorb these inflows have something in common. Every last one of them is now in financial crisis. Every last one of them is now in financial crisis because they were incapable of using these very large capital inflows in a sensible and efficient manner. And the last thing I want to say about this shift and how it has affected us was, of course, this huge rise in the capital outflow from emerging countries was not simply the result, or not even mainly the result, of market processes. They were a result of government decisions. And the best way those decisions can be measured by is in the accumulation of foreign currency reserves, which are, of course, official outflows of capital. And between 1999 and today, the world's official stock of foreign currency reserves, all of the increase, with a tiny exception for Japan coming in emerging countries, has risen from just over $1 trillion to over $10 trillion. And these capital outflows have gone predominantly to the developed world and, of course, quite particularly to the United States. If you look at it in the form of the flow of funds associated with this, by the way, you will find that the deficits with the counterpart of these external capital flows into the US occurred entirely in the US household sector and the US government sector. There's no surprise there either. Now, in my view, these were the macroeconomic preconditions for, or triggers for, the crisis. This doesn't, of course, mean that in any way that that the severity of the crisis and its nature is not related to how the financial sector performed and other governmental programs, failures of regulation, and so on. I'm not going to go into all of that. But these were, in my view, the macroeconomic conditions for what was quite simply the biggest financial meltdown the world, I think, has ever seen. Not the biggest economic crisis, but the biggest financial meltdown. A time when essentially the core financial system in the end of 2008 ceased to exist. And that then brings me to the shocks. Now, what I would like to talk about is two shocks before I conclude. The global financial and economic crisis, with particular emphasis on the US, and then, of course, the Eurozone crisis, which is the ongoing crisis. And I will try and argue that both are related to these underlying conditions that I have mentioned in complicated ways. We had a very severe crisis, and it is not over. This is the most important thing I try to say in these lectures. I know it's not what I should be saying, not what people want to hear, but it happens to be true. And there's a very, very simple way of indicating this point, which I've used many times. If you take the output of the 6 largest developed countries, so it's the US, Germany, Japan, France, Italy, and the UK, and you set the first quarter of 2008 as the beginning, where did we get to at the end of last year, which is the last quarter for which we have full results for these countries? And the fascinating thing is that there are only 2 of these countries that have even got back to the starting line, namely, interestingly, the US and Germany. Both of them, however, are very close to the starting line, namely 1% above it. So after, from first quarter of 2008 to the fourth quarter of 2011, almost 4 years, they've just got back to the starting point. France is slightly below it, and the UK, US, and Japan are between 4 and 6% below the starting point and show absolutely no sign of growth whatsoever. They're completely stagnant at present. In fact, the US and Germany are the only developed countries to show anything that looks like a recovery. This is very remarkable. These are not normal recoveries for any of these countries. What makes it even more remarkable is that in policy terms, we have thrown the whole kitchen sink at them. It is incomparably the most aggressive fiscal and monetary policies employed in peacetime in the history of the developed world. I'll just give you a few indications of that. Of course, we still live in a world when effectively the liabilities of the core financial institutions are guaranteed by states to the extent that states can still guarantee such things, which is, of course, variable across states. We have the lowest interest rates set by central banks there have ever been, consistently across all the major central banks. The highest interest rate currently employed by the most conservative central bank in the whole world is 1%. These are not normal figures. You know where the US figure is. In the case of the UK, it so happens, because we've had a central bank for a long time, we have some really wonderful data on the official interest rate set by the Bank of England. We know it all the way back to 1700. And the lowest rate the Bank of England ever set prior to today, ever, in the Great Depression, World Wars, was 2%. Today it's 0.5%. We've never had this before. I'm not even talking about what's happened to the balance sheets of the central banks. You know about that. And by the way, they've all blown up roughly the same amount. The ECB is roughly the same as the Fed and the Bank of England relative to GDP. And then, of course, we get to fiscal policy. Now, here there's been some real variation. But as a result of the crisis, and largely without deliberate fiscal action, stimulus measures taken across these countries have been quite modest and have been mostly now withdrawn. But in the case of the US, UK, and Japan, we've been running fiscal deficits in the 8 to 10% of GDP range, even higher at the extreme points. These deficits have never happened before in peacetime. Never. In the case of the UK, again, we have wonderful statistics. We know that the current financial crisis will be the fourth largest fiscal shock in British public finance history in terms of the rise of net debt relative to GDP, the other three being the Napoleonic War, the First World War, and the Second World War. We have been pursuing essentially wartime finance, not quite Second World War scale, but really big-time finance. So here we have massive fiscal support, massive monetary support, and the economy is hardly growing anywhere. Why has this happened? I think we know why this has happened, because our economies became, in the time of the boom, extraordinarily and exceptionally over-leveraged, generating internal debt levels, particularly in the household sector, which had never been experienced before, associated with extraordinary rise in asset prices, which have since collapsed, generating large falls in the net worth of much of the household sector and eliminating their ability to borrow, at the same time as damaging the financial sector, which grew even more dramatically in its leverage than any other sector of the economy. My favorite statistic on this, which I'm sure you're all familiar with, is that the total balance sheet of the US financial sector grew 6 times faster than GDP between the early 1980s and the crisis, a process that pretty obviously couldn't continue much longer. And it is those headwinds, very well described in the classic book by Carmen Reinhardt and Ken Rogoff, which explains, in my view, why all that policy impulse has led to such a miserable performance. There is only one piece of good news about all this so far, which is that despite the very large rises in net public debt in the countries that have their own central banks, not in the countries that don't, with the exception, of course, of Germany, which has a very disciplined fiscal position since it didn't have a financial bubble. As I like to say, it subcontracted that to its clients. The government interest rates have remained extraordinarily low, and that has given them the room to continue to borrow without a serious fiscal crisis. And perhaps the best indication of the severity of those conditions is given by taking forward my little story on real interest rates to today. I'm sure you know that at present, the real interest rate on index-linked bonds in the US and the UK, and by the way, France and Germany, is 0. A 0 real interest rate world is a really weird world. If you take it seriously, the value of almost any asset should be infinite, but I won't go into that. It is a puzzle that they're not higher than it is. But it is, I think, the best possible indication that we are in what I have described as a contained depression. Now let me move, if I may, from that overall view of what we've been trying to do to the very specific problems of the Eurozone. Because the important characteristic of the Eurozone is that essentially it's the same process, but without the same adjustment mechanisms and without the same financial conditions, it is generating severe sovereign insolvency risk. And that changes the nature of the crisis in absolutely fundamental ways, which also happen to be extremely dangerous even on a global level, because some of the debtors are really, really big debtors. Italy is, I think, the 3rd or 4th, it wobbles day by day, largest debtor in the world. In essence, what happened in the Eurozone was a microcosm of, exacerbated by, the global conditions I described. Essentially at a time of very low real interest rates and very easy credit supply, a number of countries and individual borrowers and corporations that had previously been unable to borrow easily because they were in countries like Italy and Spain, which used to have, or Ireland, high interest rates and was regarded as high risk, suddenly found they could borrow on terms never before possible. All risk spreads on sovereign bonds in the Eurozone disappeared. There was even, miraculously, a period in 2006, if I remember correctly, when Irish bonds offered lower interest rates. Think about where Ireland is today. Lower interest rates than Germany. Not much lower, but the spread was negative. Essentially, they were treated as riskless, and so were all the banks associated with them. There was no sign of risk perception in the credit default swap market. And in that context, enormous capital flows emerged within the Eurozone. It became a microcosm of the world, with Germany as an enormous surplus country, gaining competitiveness year by year, the constant fall in inflation and in unit labor costs, because there was no housing bubble in Germany. They didn't let it happen. And the peripheral countries, which found these incredibly attractive conditions, going on the borrowing binge of all time. Much of it private borrowing into the housing sector. That was particularly dramatic. Construction sector in Italy, in Ireland, and in Spain. In some cases, it was predominantly fiscal, but it didn't really matter. It just depended on who was willing to borrow. And the borrowings became incredible, and the current account deficits that Spain, Portugal, and Greece were able to run amounted to 10% of GDP. And when you can borrow that much to import tradable goods and services, which obviously were what they were importing, you can allow your unit labor costs to go through the moon. You can allow your wages to go up because you don't have to be competitive. You just can import it through these capital flows. And they became dramatically uncompetitive. The worst story of all is that the unit labor costs in manufacturing of Greece relative to Germany rose between 1999, the beginning of the Eurozone, and today by 80%. Now, Greece is in a class of its own, but even Spain and Italy experienced relative rises in unit labor costs of manufacturing of close to 40%. So a huge structural competitive advantage emerged in Germany, and these countries became hopelessly uncompetitive. It is important to stress, because people oversimplify this story, that this is not predominantly, as I've said, a public finance story. It's an easy credit story where it went to very dramatically. The most interesting indications of what I've just said, are actually Ireland and Spain. Because Ireland's story is so extraordinary, and I don't know how many people know it. I've never seen anything like this before. Just before the financial crisis hit, the net public debt of Ireland was 10% of GDP. Essentially, Ireland didn't have any public debt. It was essentially zero. Nor was the Irish welfare state and welfare state promises particularly generous. Taxes were relatively low. The fiscal position was incredibly strong. Now, 4 years later, the net public debt of Ireland is more than 100% of GDP. In 4 years, it went from 10 to 110, roughly. About a third of this was because they had to bail out all their banks, or they felt they had to bail out their banks, or they were forced to bail out their banks. There are many different versions of this story. It's actually a bit of both, or a bit of all three. And about 2/3 is because they hit the most whopping recession, because their housing sector imploded, their banks disappeared, they went into free fall. Spain is a less extreme version of the same story, but prior to the crisis, Spanish net public debt was slightly over 20% of GDP, and much better than Germany's or France's, or if I may say so, the US or the UK. Today, Spain's public debt is rising rapidly because it has huge fiscal deficits as a result of its economic collapse, and now increasingly because it has to bail out its banks. The fiscal crises in these cases, and this is also largely true of Portugal, are a consequence of the crisis, not a cause of the crisis. Greece is, in fact, sui generis. Now, when the crisis hit, and people start saying to themselves, wait a minute, let's just see whether these people actually have the slightest chance of ever being able to pay us back. Something that pretty well everybody in the financial sector seems to have forgotten was an important element in finance prior to the crisis. This is way beyond, this is European subprime we're talking about here. The subprime included governments. So they suddenly realized there was a problem. And when they realized there was a problem, and here we're talking particularly about German bankers and French bankers, British bankers, the Americans are not essentially involved in this, the money just stopped. Just stopped. The spreads exploded, and quite suddenly governments that had been able to borrow as if there was no tomorrow could now no longer borrow at all. And that was the crisis. It started with Greece and then Ireland and Portugal. There was another wave later which got to Spain and Italy. And the characteristic in all these cases was people stopped borrowing, stopped lending across the borders, risk spreads exploded, interest rates very quickly moved up on these sovereign debts to rates at which they could no longer manage the rollovers at all. So how did the Eurozone manage this enormous crisis in their internal balance of payments? Because nobody was prepared to lend cross-border to finance these governments that were clearly dependent on foreign finance. And the answer is one that is quite surprising and very well hidden until relatively recent and rather thrilling. Namely, the European Central Bank financed all this through its lender of last resort operations for banks. Essentially, the European system of central banks allowed the national central banks to provide liquidity to domestic business and, far more importantly, to domestic governments, and the European Central Bank was willing to accept the collateral of the government paper, haircut somewhat, as collateral for its lending. And as a result of these processes, through the monetary system, the European Central Bank emerged as the European Monetary Fund, as I've called it. And the Germans, obviously, through this intra-bank financial system, ended up financing the periphery through official channels. And because the ECB hated this so much, it really essentially forced governments to start creating these more official funds, which are the ones you've heard about, the European Financial Stability Facility, the European Stability Mechanism, the IMF programs. But even now, today, the dominant financier is in fact the European Central Bank, and this is all shown up in the internal balance sheets of the banks, of the central bank, which currently I think shows a net creditor position for the Bundesbank to the tune of something like 700 billion euros, which I think is about a quarter of German GDP. I would have to check, but I think it would be about that. So Germany has been forced, as creditors always are when their debtors go under, to bail them out, because it doesn't want to write off the losses, and it doesn't want to write off its export sector. So that is essentially how the Eurozone system is being managed, through this heroic intervention, in the hope that somehow or other everything will work out. The latest stage of this was this truly astonishing long-term refinancing operation announced very quietly by Mario Draghi last December, in which in just 2 months the Eurozone advanced 1 trillion euros, which is real money, to by anybody's standards, what would that be, $1.3 trillion, something like that, to banks that were in this crisis situation no longer able to finance themselves at all, many of them being German. Now, so that's where we are. That we had the shift, this generated the shocks, and we are now struggling to get out of it. So let me just conclude briefly with what I think this might mean for the future in our struggle to get back to something more balanced. I don't say something more normal because there's no normal to get back to. That's one point on which I agree completely with Mohammed El-Erian. We're not going back to the way the world was before the crisis because that was unsustainable nonsense. Essentially, I think the way to think about what's going on here is there are two really big forces at work, really big forces. The first is a secular shift in the location of economic activity and power, and the second is the reversal of a generational expansion in private and to a lesser extent public sector leverage in high-income countries, which reached its crescendo over the last decade or so. And the Eurozone crisis falls squarely at the intersection of these processes. So how might it all play out? Well, I think in terms of the growth prospects, the general consensus, which I broadly share, is that the US has done enough to continue a slow, weak recovery in these difficult economic circumstances. But given the impossibility of going back to the sort of household spending boom we saw before the crisis, which would require another great housing boom, given the extreme and understandable caution of the US non-financial corporate sector and the continued weakness of the credit supply, I don't see a really strong private sector recovery, and I'm prepared to predict that the fiscal deficits will remain huge for years, whatever fiscal policy is. The government doesn't control its fiscal position in a situation like this, as the Spanish are discovering. The emerging countries are, meanwhile, doing pretty well. There's been lots of discussions of problems in the emerging countries. Some have now large current account deficits with potential serious weaknesses. I'm particularly thinking here of Turkey and Brazil. I'm less persuaded than others that we're going to see a collapse in China, but China clearly has significant fragility. But I think it's reasonable to believe that whatever short-term difficulties emerge, the great basic dynamic of the shift, which is the catch-up process, will continue. We are going to go on living in a world in which the developed countries decline, or as I like to say, a sixth or less, much less than a sixth of the world's population don't get to run the world forever. Sorry, chums, that's how it is. On the prospects at the global level, to get to a healthy recovery, we need to accelerate the deleverage in the over-leveraged private sectors. That applies here in my country very much so, and in other developed countries. We need to rebalance the world economy. That's continued to give over-leveraged economies export-led growth. Quite a lot of that's happening. We obviously need to reduce our fiscal deficit successfully without killing our recovery. And in the meantime, we have to avoid severe excess in emerging countries, particular emerging countries where the deficits are now shifting. Meanwhile, the Eurozone essentially faces a 5 to 10 year adjustment problem if it can survive, and the stresses are going to be extreme. They've got to manage adjustment of these extraordinary imbalances which I've described internally, get these countries back into external balance, in fact, even into surplus, to support their economies while the fiscal position adjusts. They're going to have to finance this in the short to medium run. Basically, that's almost certainly going to mean even larger flows from the European Central Bank. And one of the really big questions is how large a surplus the Bundesbank is going to be willing to take before it basically tells the German government that it's going to go public on the implications if all this is lost. Adjustment means structural reform and divergent inflation across the Eurozone. The system will not return to stability as I like to say when I want to be really unpopular in Germany, without German inflation at 4 to 5% a year for about a decade. They don't like this idea. And then I say, well, the alternative is going to collapse. There you are. That's your choice. The big danger here, and we're seeing the consequences now, is premature fiscal tightening in the periphery, which will force these economies into deep depressions. Spain's unemployment rate is 23% at the moment, and youth unemployment is nearly 50%. It cannot get worse, in my view, before the politics break up. Final, very last words, guesses about the future. I believe it is probable that the US will remain the most dynamic of the large economies of the world. It has all the necessary conditions. That may not be as dynamic as you'd want, but better than anybody else. Growth in high-income countries is likely to remain weak for quite a long time as we get rid of all these excesses. And remember, in the end, Germany's also gone into very slow growth, and the main reason for that, it has to export to other developed countries. It can't just live off China. Inflation is, I think, going to remain contained. I think all the people who are worried about the immediate move into hyperinflation are going to be proved wrong. 2 years ago, I was moderating a panel in Dalian with a very distinguished American who informed me with absolute confidence that today the US will be in hyperinflation. I said to him, I simply have no idea why you think that, and I remain convinced of that view. Short-term official interest rates are going to remain low in our contained depression, and countries with their own central banks will continue to enjoy low long-term bond rates. But Eurozone countries which don't have a central bank in the same way do not. There is very significant Eurozone breakup risk, and that has very profound implications for the future of Europe and the transatlantic relationship, if I'm correct. And as I said, emerging countries seem likely to continue to be the winners. I wish I could come here and say something vastly more cheerful, but as I like to say at this point, it could be much worse. If we'd made a real mess of it, we would be in Great Depression too. And I think that at least is something, from my point of view, to remember with gratitude. Thank you very much.
Among the others, at the end, about the breakup of the Eurozone. Could you just elaborate on that a little bit? And in other words, move over into the political and national political, multinational political side of this for a bit.
Well, essentially, the argument is this. As I've tried to describe, getting back from where they are to something healthy requires very, very large adjustments, which are necessarily on both sides. They have to be. Deficits and surpluses, creditors and debtors are tied together in that way. And in the meantime, while these adjustments occur, and they cannot occur very quickly because they involve creating essentially new economies, I mean, in some cases, there's going to have to be financing. Now, at the moment, there's barely adequate financing, but there's been adequate, and there's been very limited real adjustment. It's begun, but it's been very limited. If anything, competitiveness has diverged in the crisis rather than converged so far. The Eurozone economy as a whole is not growing, which makes the adjustment of the countries that are really very, very weak much more difficult because they don't have markets to export into. And in that situation, there are really only two consequences for the countries in the periphery. Either they manage to adjust by breaking out into world markets, which I think the strength of the euro and their own lack of competitiveness makes almost impossible, not completely, but almost impossible, or they accept permanent recession. They cannot have a better than permanent recession. They're hopelessly uncompetitive. They're going to cut their fiscal deficits. The private sector in this situation will be stagnant because it's hopelessly uncompetitive, and the credit supply has diminished because the banks are in such terrible trouble. I didn't have time to discuss this, but obviously the banks are in terrible trouble. My column on Wednesday will discuss this. And so they will be completely stagnant at best. possibly worse than completely stagnant, quite likely actually to be continuing to decline, and that means ever rising unemployment. Now, a situation in which major countries find themselves with chronically weak public finances, with the banks increasingly forced to buy the government debt, because there's no one else, with financed by the ECB, with structurally high unemployment and very little prospect of a return to growth, politics becomes, I think, ultimately unmanageable. It's only a matter of time. The election of François Hollande in France, not the worst hit country by any means, is just an indicator of this. It's not that anybody particularly admires François Hollande, about whom they know nothing, but they are completely had it with the present government, which at least pretended to reform. Hollande won't even do that. The Spanish government has lost popularity dramatically in just a few months, and Mario Monti will be out quite soon. And how much will be left of what he does, probably out, will not be clear. So the programs of adjustment and reform are very uncertain, and there's a very big danger, I think, that the crisis will spread to France. There's a very big danger, particularly if you now have a head-on conflict between the French president, if that happens, and Angela Merkel over how this should be managed, which is what he's setting himself up for. That may not happen, but it is, I think, quite likely, which will add to the uncertainty and a real risk that the wealthy of France will just dump French assets. And then you have a fiscal crisis in France. This starts getting serious. So what will Germany do in this situation? I think it's quite possible that Germany will say, we tried to save these people, but this is too much. We can't bail out all this. Slightly irrational, but I think it's the politics of it. There are other possible outcomes. They could make heroic changes in the way they manage their economy, but at the moment it seems very unlikely. So I see at the moment the next year or two, and I felt this very strongly when there was that ludicrous euphoria after the LTRO that the problems were all gone. The next 2 or 3 really are going to do something that will fix it. We can discuss what that involves. But my perception is that they're bound to get worse. In this situation, politicians can lose control very easily. It's true that the respectable, quote-unquote, pro-European parties win elections and they continue to have these desires, but I think there is a point at which it becomes quite difficult to manage. So all I could say in answer to your question is it's going to be a really, really difficult road over the next few years. In essence, one very simple way of thinking about this is you're trying to impose massive changes in relative prices, which involve, among other things, absolute falls in wages, nominal wages, in the most rigid labor markets in the world. This is tough.
Thank you. And I didn't even ask you for the impact of that Eurozone breakup on the global economy. But,
I'm not saying it will happen. I'm just saying they're going to have to do quite a bit to stop it.
All right. Floor is open to all of you. Once I recognize you, please wait until the microphone comes to you to state your question, and do so briefly so we have a time for maximum number of people to intervene. Yes, gentleman here, please.
There's a debate going on in this country concerning austerity versus short-term growth stimulus. The Republicans are arguing for austerity. The New York Times editorials are arguing for stimulus short-term. Would you comment on that, please?
Well, everybody knows I'm very unsound on this. I have no doubt that as I said, I don't think the fiscal deficit can be closed here. So it's a waste of time trying, except through a depression. So the answer to this, in my view, is very simple. You can start cutting the fiscal deficit rapidly, surprisingly rapidly, in fact, when the economy returns to growth. That will happen, in my view, when the deleveraging process is largely done. And we're not there yet. The US is closer to it, but we're not there yet. I suspect it will be a few more years. In the meantime, the government has to provide, since the private sector is deleveraging, the government sector has to leverage. One way or the other, that's what's going to happen. There are alternative ways of doing it, which will be the implication of a serious austerity program, which is you essentially push through a mass bankruptcy process in the private sector. That will give you a depression in the short run, but no doubt there's life after that. But I have no doubt that if you want a continued recovery, the fiscal support will be needed. But I understand that an experiment of this kind might well be started later this year, because there is in the works a massive automatic fiscal tightening, which according to what I've read could be about 4% of GDP. If that is the case, and if it happens, we'll have one of the neatest pure experiments in economic policy we can imagine. I expect it to cause a big recession. Now, none of this rules out the obvious fact that the very long-term public finances position of the United States do not look sustainable on current trends, and therefore there have to be large changes. I'm going to make myself even more unpopular than I already made myself by saying that nobody, in my view, can look at the arithmetic of the US and reach the conclusion that this can happen without, one, a complete transformation of the trajectory for healthcare spending, and two, higher taxes. This is an astonishingly undertaxed country. Now I've really made myself unpopular.
Applause.
I could go on to that later. But anyway, short run, fiscal support, long run, massive reductions in structural deficits are clearly needed.
My question is regarding the fiscal integration, talks on that in Europe, and the hurdles to that, and behind that, the demographic-driven entitlement programs and how that is impacting the story, especially as Europe ages.
There are a few different things. The first thing you've asked really is about, well, the last thing you asked is, what are the long-term fiscal position, very long-term fiscal position of European countries given their aging? The interesting thing about that, first of all, in a number of countries it's quite serious because the aging is so severe. Those countries which have had extremely low birth rates and very large rises in longevity, Italy is perhaps the most important, but Spain is another, clearly suffer from very severe long-term fiscal problems. Interestingly, however, some of the countries with the strongest credit also have these problems, Germany particularly. So the markets are not distinguishing between countries on the basis of these long-term fiscal challenges. They're really responding largely to the balance of payments positions, as I have already indicated. But it's clearly an issue. Now, the fact that people are worried about long-term fiscal positions is, of course, one reason why countries do not want to take on large open-ended fiscal burdens to support countries that are in trouble. And that gets to your question about fiscal integration. And I perfectly well understand that, particularly because it would almost certainly mean an ongoing transfer, given the starting point, from the north to the south. And I think, and I've argued this, that will be extremely undesirable, because first, it would be very difficult for the northern countries to afford in the long run. And second, and in my view even more important, it risks turning the whole of southern Europe into a huge mezzogiorno. And that would, I think, be a complete disaster. That is to say, for those who don't know it, Italy, an integrated country with large fiscal transfers inside Italy and considerable pressure for wage equalization, has a northern economy which is competitive, dynamic and profitable, and a southern economy which is the inverse, and a constant flow of money from the north and the south has maintained the Mezzogiorno, the south of Italy, as essentially a corrupt and backward economy. Such transfers, in my view, across borders would be a disaster because it would leave some economies permanently weak. So my view is I'm not in favor of full fiscal integration, and I fully agree with the German position on this, but the funds that are needed to support countries during times of severe crisis to avoid unnecessary fiscal defaults, I think they're unnecessary, and to facilitate the adjustment have to be large enough to manage these adjustments in the absence of exchange rate adjustments. So the ESM is the right mechanism, it just has to be somewhat bigger. And then the other thing they have to do, which I think is a lesson we all have to take from American experience, is that the core financial system has to be federalized. Nation states cannot support their own banking systems in a completely integrated financial system without complete implosion because they don't have the fiscal resources anymore to back them. And they don't have a central bank to back them. But beyond that, I think the idea of a full integration of the fiscal position, having a federation with ongoing transfers from strong economies to weak economies is a very, very bad idea, and Europe should avoid it.
This gentleman here, please.
You dropped a juicy comment about your next column being about the banking system in Europe. I'm now dispositionally ill-prepared to wait till your column comes out. Please comment.
Well, I have to say that there's nothing in my column on this which is not contained in what I think is an admirable report in the Global Financial Stability Report of the IMF, available on the IMF's website, and which contains a staggering amount of information on the state of the banks. The most important implications that I've tried to bring out in this are, first, that they believe that under any under any plausible scenario, there's going to be a very large credit shrinkage, bank credit shrinkage in Europe. The figure they put as the most plausible figure based on their analysis of 58 big banks is a total of $2.6 trillion decline in credit, almost all of which will hit the peripheral economies. And of course, it doesn't take any great genius to realize that if that happens, these economies aren't going to recover. So that's one big issue. The second big issue is that there is increasing pressure on the banks of the peripheral countries to take on the debts of their sovereigns, because nobody else will. And this is very important because in some cases, let me take Italy, which is a figure I happen to know. As a result of the Eurozone establishment, about half of Italian debt is now held abroad. So that never used to be the case. It is now held abroad. And of course, the people who hold it, to the extent that they are, if they're hedge funds, not a problem, but we're talking about massive quantities of debt. So clearly can't be predominantly held by hedge funds because they would then have about a third of their portfolios in Italian debt, and I don't think that's the case. So we know a lot of this has been held by insurance companies and pension funds and so forth, and they will no longer regard this as a reasonable investment. Therefore, they will want to get out of it. And that means that in addition to the rollover problem, the Italian banks, I suspect, will be coerced, cajoled, and encouraged to take up this debt from their governments, in which case there will be even less to lend at home. So from these two facts, I conclude the great likelihood that there will be extraordinarily severe credit conditions in a number of the peripheral countries, unless something very dramatic is done. Perhaps I could add to the third point, this means, of course, to offset this, there has to be a very, very large increase in the capital of these banks. Otherwise, they're completely reliant on the ECB, and that capital will not come from their own governments. It will come inevitably from, or in large part, from the European facilities. Indeed, that may end up being how they're used. But I think the banking stresses and the links between the banks and the sovereigns in the peripheral countries remain a very profound point of weakness, and it underlines my point that domestic private sector recovery is not going to drive those recoveries in these countries. They have to come in significant measure on the external sector, and that's going to be a huge problem for them, even for Italy and Spain, which are in relatively good shape. The only country which really does have the possibility, I think, of expanding quite well from the external sector, though even then may not be enough, but because it's a very small, open and competitive economy, is Ireland.
Yes. Gentleman here, please.
Let's assume that Europe does go down the toilet. What is the implication of that for our economy and for the Chinese economy?
That's an interesting one. It depends in part on how this happens. Okay, there are so many scenarios on this. Let's think of the process and the end state. The process is a very messy one. And though there's been a fairly large amount, let's suppose it breaks up. They agree to break it up. Or they're forced into a situation where countries just do decide it's too agonizing. You'll realize why they might not think it's a good idea when I've gone through this. But in essence, what happens then is that new currencies introduce and debts are redenominated in these new currencies. I haven't even tried to talk about which debts will be redenominated and how, but the general view would be domestic law debts will be redenominated in the new currency, and debts contracted in foreign jurisdictions, mostly London, though some in Frankfurt, will not. They will just go belly up. Now, there are a few things that would happen in this situation. There will be runs on all the banks, obviously. There would probably have to be exchange controls, which are illegal under European law, and there are no machinery for delivering it. And nobody would know what any bank was worth. All you have to do is think about the following question. Let us suppose, I'm not saying it's going to happen, of course, that you were told that the United States dollar was going to be broken up on an unforeseeable day into the dollars of the regional feds, which would then float against each other. And you were then asked the question, what is the value of Bank America on day one? I promise you, you wouldn't have a clue. That would be the situation for all the major European banks, to the extent that they still operated cross-border. So the financial sector would freeze completely. There wouldn't be one until you sorted all that out and you worked out all the assets and liabilities. Now, I presume they are slowly going through all this process and working out what the assets and liabilities of every bank is and where they are. Even then, they wouldn't know the policies of the new governments, whether they got access to this. Certainly, the banks are increasingly trying to match their portfolios country by country, assets and liabilities, in order to avoid this very risk. By the way, that's fragmenting the Eurozone banking system, and that links to the point we discussed earlier. But it would still be a huge mess. It's because it's such a huge mess that they really don't want to think about this. But in this situation, since the Eurozone banking system is one of the two biggest banking systems in the world, and I think its balance sheet is still significantly larger than the American one, you can safely assume that it will be a large global financial mess. Now, I assume that somewhat before this, American banks would have pulled in all their, or would have tried to pull in all their lines. Tricky to do, since they're the major customers. And of course, the US has lent them lots of money through the Federal Reserve. So there will be inevitably financial linkages. It's just that there would be, but I wouldn't know how significant they would be. The Eurozone economy would decline dramatically. Financing from Eurozone banks, which are very important for emerging countries, would disappear, and there will be a large shock to the world economy. it's just inevitable there will be a large shock. I can't judge how large, but it would inevitably be significant, and it would affect the US and Europe. US corporations have huge assets in Europe. I think that's still probably the largest stock of their overseas investment of US firms are in these countries, all of which would have to work out their currency positions. And of course, enormous amount of trade is done with Europe. So it will be a global shock. That's the process, and it's sort of such a huge mess that most people just, as soon as they start thinking about it, there's a prize actually. A friend of mine, Simon Wolfson, has put up £250,000 for the prize for the best way of breaking it up. And the main conclusion I've reached from reading the proposals is that it's really hard to do. It's a 17-sided marriage with no divorce, with no prenup. It's a really big problem. This is what this would involve. Now, after that, one would assume things will somehow get back to normal, provided, but it's not quite clear what normal would be. All the European laws would have been broken. It's not clear how much of the single market would remain, because one of the reasons they created the Eurozone was precisely to have a single currency to go with the single market. They believed it would be impossible to have all these currencies floating against each other. It's not like having the US as the core of NAFTA. There's no core like that. All this integration would go. So that would be a big mess. There might be protection, who knows. The Eurozone project came as the top of the EU project, and we don't know how much of that would remain in this situation. So since this project of yours is partly about NATO, I think that would have some implications for this. At the most profound level, the US and European drive to create a more integrated Europe, which has been a dominant feature of post-war policy, of course influenced by the Cold War, among other things, would have taken a massive shock. So it has a geopolitical implications as well. So I've just gone through some of the detailed aspects of it. I think the big conclusion I would make is nobody knows. It will be a mess. The mess would be over at some stage, and the world that would exist after that mess is over is really radically unpredictable, because it will be a fundamental regime change. It will be a different world. And that is why I have argued that in the end, confronted with this horrible mess, the Europeans are going to do everything they possibly can to keep this thing going, and we shouldn't underestimate their determination to do so, because the alternative is in some fundamental way, in these many ways, unthinkable. Now, people do unthinkable things. God, they do. But just possibly, they won't. And I think it's important for people outside Europe, particularly in America, not to underestimate what the major leaders at least think is at stake here, precisely because of the possible chaos it could cause economically, socially, and politically. Europe ain't what it used to be, but it's still the largest economy in the world.
We have time for one more question, and the lady on the end here, please.
It's really a pleasure to come here to listen to your speech. And then my question is related with China. What do you think about the relationship between America and China in the financial situation, and the deficit and debt, and especially about the currency? Okay, and China got a lot of inflation right now. The labor cost, everything costs more right now. So, and in China, the Chinese yuan, what I mean, the money, it's kind of like because the inflation is lower, it's lower, okay? And then right now, compared with the US dollar, it's getting worse, it's getting more. What do you, predict the relationship in the future?
Okay, it's a good question, and I will make two comments. I try to be brief. I usually fail with these things. There's a real phenomenon going on, and there's a nominal phenomenon. So it's important to distinguish them because they're linked. real wages are rising in China. This is a very good thing. That is why China is developing. I had a debate with some Chinese economists about 4 years ago, before the crisis, when I told them that there was going to be a crisis and they could forget the export-led growth. This was not very popular. Then they said, but in addition to all these problems, real wages are going to rise. And I said, that's not a problem. That's what development's for. The aim of development is to increase real wages, and thank heavens that's happening in China. Of course, this is the real side. As real wages in China are rising, and they are rising quite rapidly from the statistics I've seen, that forces coastal China out of labor-intensive manufacturing, which is very good for inland China and for the rest of the emerging world. So development opportunities being spread out, and of course China has to go up market and upgrade and improve the quality of its output, which it's going to do, and it's going to increase the competitive pressure on our more sophisticated producers in the developed world, and we better look out for it. This is the real process going on. Another aspect of the real process, which is much more complicated, has been rises in commodity prices. It's sort of some domestically produced and so forth, where I think the most important factor is simply the growth in demand. I mean, there have been other things, but simply the growth in demand from China and other emerging countries, and the inability in the short run to increase supply. Supply is going to increase, and there'll be some commodity price busts. But those are, I think, your inflationary processes are not fundamentally inflationary processes. They're real processes. That's the real side. The nominal side is, and this is an argument I've been making with China for about 7 or 8 years, is that for China's point of view, the Chinese government's point of view, there are only 2 ways, very crudely, to handle these real processes. You either fix your exchange rate and allow domestic inflation to generate the real exchange rate appreciation. This is what we're talking about, so real exchange rate appreciation. Or you allow the exchange rate to go up, and you don't have domestic inflation. And my argument was, since you hate domestic inflation, why not let the exchange rate go up? Yes, if you don't allow the exchange rate go up, you temporarily subsidize, through your exchange rate manipulation, the survival of labor-intensive manufacturing, which is going to disappear anyway, so it gives them another 3 or 4 years in Guangdong and so forth. But that's silly. That's just a temporary subsidy, and in return for this, you accumulate vast quantities of US dollars, over 3 trillion, in what I would think will turn out to be among the worst investments in the history of humanity. And I've made this argument many times in China. Anyway, so I think they should have continued with the appreciation. They were right to start it. They should have done more of it. And they got into some domestic macroeconomic problems. Now, my reading of it is that they basically got that. And they are now pretty determined to let the exchange rate move if it helps them manage the domestic inflationary pressures. But there remains this gigantically powerful export lobby in China. One of the things that I find most interesting about China, I don't understand Chinese politics at all, but interest groups seem to work just like in the West. And the export lobby is pretty powerful, and it resists anything that raises the exchange rate through a deliberate policy. But I think the general sense in China is that the reserves have accumulated to excessive levels. They cannot be, 4, 5, 6 trillion is absurd, and that the policy system has to change. They've already largely eliminated, or pretty well eliminated, the current account surplus. It now seems plausible that it is gone. And I think these adjustments are beginning to work through, but they've gone through, they could have been done better. I think it's largely a result of the fact that the government couldn't reach a consensus on a more sensible policy. It wasn't probably a huge error overall, but in the end, China has ended up with $3 trillion of reserves, which is probably $1.5 trillion more than they need, and $3 trillion is what, $2,500 for every man, woman, and child? This is a poor country. It's a hell of an investment, predominantly in U.S. Treasury liabilities. What do you think the future of that is?
Martin, once again, you've provided us with an extraordinary overview and insight into what's going on with great clarity. And I much appreciate your coming back to Chicago. Ladies and gentlemen, please join with me in thanking Martin.